Welcome to the deep dive. Today we are cracking open a business topic that sounds, on the surface, incredibly dry. Credit policy.
hmm
We're talking about the terms and conditions a company sets for getting paid. But our mission is to show you that this isn't dull spreadsheet filler. It is, in reality, a core pillar of competitive strategy and, well, ultimately, business survival.
It absolutely is. I mean,
Yeah.
so many entrepreneurs focus entirely on product design or their marketing budget, but they forget that how you ask for money, your credit policy, that defines your customer relationship.
And it sets the pace for your entire cash flow cycle.
Exactly.
The sources we've pulled together today treat credit policy less like an accounting function and more like, a brand statement. Think about that classic film analogy our sources reference. George Bailey versus Mr. Potter in It's a Wonderful Life.
Right.
Both of them extended credit. They both allowed people to pay later.
But their policies were poles apart.
Yeah.
I mean, George Bailey's terms, they were based on trust, on community, that allowed for flexibility and loyalty. Mr. Potter's approach was purely transactional, extractive, really.
And the lesson there is timeless. It just illustrates that your policy, the rules and the spirit in which they're enforced, that's what impacts customer loyalty, perceived risk, and your competitive standing.
So let's start with the basics of setting that policy.
Okay.
We're synthesizing material here that moves from high-level strategy all the way down to detailed tactical budgeting,
Right. So the starting point is the credit period. This is just the amount of time you allow a customer to pay the invoice. The most common term you'll see is net 30.
meaning the full amount is due within 30 days.
Yep. And this initial decision is pure strategy.
And it presents that fundamental trade-off. What's the balance management has to strike when they're deciding between, say, net 10, net 30, or maybe even a net 60? Well, if you opt for a longer credit period, say net 60, it's a powerful customer attraction tool. It reduces the immediate cash burden on your buyer, making your offer just inherently more attractive.
You're basically financing their purchase for them.
You are. But the trade-off is clear. You're taking on higher carrying costs, your money is tied up longer, and your risk of bad debt, the customer who just never pays it, goes up significantly.
And what if you swing the other way? Demand payment quickly, like net 10.
Your cash flow improves immediately, your risk exposure shrinks. But, and this is the key, you cannot make this decision in a vacuum. Industry norms act as this powerful strategic anchor.
So if everyone else in your industry is doing net 30.
And you unilaterally demand net 10, you're making a very high-stakes decision. Buyers prioritize their own cash management. If all your competitors are offering 30 days of free financing and you only offer 10, the customer needs a really compelling reason to choose you.
Like a massive quality difference or a better price.
Exactly. A startup trying to grab market share might even choose net 60 to be aggressive. But a stable utility company might use net 15 because, well, its position is secure and protecting cash is everything. That period length defines who you are as a business.
That sets the stage perfectly for the next lever, which is how you incentivize behavior within that period. We're moving from the basic structure to the incentive game.
The sales discount.
And this is where we uncover that financial secret that really changes everything for the buyer.
Yes, companies rarely just stick with a simple net 30. They use a very specific notation to try and accelerate that timeline, offering a carrot to customers. The notation you see everywhere is 200 net 30.
Okay, walk us through what that actually means step by step.
It's a two-part instruction. The net 30 means the full invoice amount is due in 30 days, just like we said. But the 210 part is the incentive. You get a 2% discount on the total price if you pay within 10 days.
Okay, so let's put on our buyer hat. We've just made a $1,000 purchase under these 210 net 30 terms. I've got two options. Option 1, I pay $980 on day 10. Option 2, I wait and pay the full $1,000 on day 30. My first instinct is often, keep the cash as long as possible. Why should I rush to find $980 right now when I could just wait 20 more days and pay an extra 20?
But because that $20 you pay for the privilege of keeping your cash for an extra 20 days is not a simple $20 fee, it is an astronomical interest payment.
What do you mean?
By not taking the discount, you are effectively taking a very short-term loan of $980,
Right.
the discounted price, and you're paying $20 in interest for it.
For just 20 days, from day 10 to day 30.
For a 20-day loan, exactly.
Okay, let's hit them with the math that makes this so shocking. What is the effective annual rate of that loan?
So first, we need the periodic interest rate. You take the $20 in interest and divide it by the $980 principal you borrowed.
Okay, 20 divided by 900.
That comes out to about 2.04% for that 20-day period.
2% for 20 days still doesn't sound too bad.
Right, but now we have to annualize it. How many 20-day periods are there in a 365-day year? So 365 divided by 20, that gives us 18.25 periods.
So we take the periodic rate, that 2.04%, and multiply it by 18.25.
And that calculation delivers the effective annual interest rate the buyer is paying by missing that discount. And it is 37.2%.
37.2%? That's a staggering amount. I mean, if I went to a bank for a loan, even a high-interest one, I would never accept 37.2%.
You wouldn't. And that is the actionable takeaway for every single listener. The cost of missing the discount is completely prohibitive. Our sources strongly advise that if you can't pay early from your own cash, you should literally go to your bank, take out a short-term commercial loan, maybe at 8%, use that to pay the $980, and take the discount.
So you use the bank's cheap money to avoid the vendor's ultra-expensive implied financing.
You got it. It's a no-brainer.
This raises a critical question, though. If the cost is 37.2% for the buyer, why would the seller offer it? Are they just giving away 2% to get their cash 20 days earlier?
They are, but they gain far more than they lose. Cash acceleration is everything. If the seller can turn inventory into cash 20 days faster, they can reinvest it, pay down their own debt, or jump on opportunities. That accelerated working capital is often worth much more to them than the 2% they give up.
And speaking of that 2%, we should probably do a quick accounting interlude here.
We should, because on the seller's books, those sales discounts are not treated as a typical expense. They're recorded in what's called a contra revenue account.
Which means it reduces the top-line sales number.
It reduces gross sales down to the public-facing net sales. This lets the company manage its cash flow aggressively without that whole discount structure being immediately obvious to outsiders looking at their income statement. It's part of the hidden strategy.
Fascinating. So we've covered the carrot, the discount strategy, but our sources also mention the alternative, the stick.
The stick is just charging interest on balances that go overdue. So past the net 30 or net 60 deadline. Instead of incentivizing speed, you're penalizing delay. A massive retailer like Target generates significant revenue this way through its credit cards.
Right, where the interest fees become a whole new revenue stream.
Exactly. Both methods put a financial cost on the buyer, but they serve very different goals for the seller.
Okay, so we've set the policy, we've implemented the incentives. Now we move to the final, crucial step, active financial management. And this is where we confront that core truth that keeps businesses alive.
Cash is not the same thing as sales.
Say it again? That
don't-
is so vital.
It is. We've seen countless examples of companies that look profitable on their income statement. Huge sales, great margins, but they fail. They fail because they are illiquid. They just run out of cash before the receivables come in. They die waiting for the money they are owed.
And to navigate that, you need the right tools. We're not talking about the big strategic forecasted statement of cash flows. We're talking about the detailed, short-term tactical tool, the cash budget.
The cash budget is essential. It forces you to forecast exactly when money will arrive, maybe down to the week. This is what you take to the bank to get a line of credit. It's all about timing.
And the entire forecast hinges on predicting cash receipts. You need 3 inputs: historical sales, future sales forecasts, and, critically, the collection pattern.
That aging schedule, yes. It tells us what percentage of sales converts to cash this month, next month, and the month after.
So let's work through a quick example from one of our sources, a company called Timmons Company. They have a pretty standard collection pattern.
Very standard. For every dollar of sales, 20% is cash. The other 80% is credit. Of that credit portion, they collect 30% in the month of the sale, 50% in the following month, and 18% in the second month.
And that last 2% is just assumed to be bad debt.
Correct. Written off.
Okay, let's calculate the total cash that actually arrives in January. We need our inputs. January sales are forecasted at $100,000, December sales were $200,000, and November sales were $100,000.
Okay, so we have to trace 4 separate streams of cash. Let's start with the easiest one. January cash sales.
Right. 20% of January's total sales of $100,000 is cash. So that's $20,000 hitting the bank in January, stream 1.
Stream 2 comes from the credit sales made in January. They're paid quickly. That's 30% of the credit portion. So if $100,000 was total sales, $80,000 was credit.
And 30% of that $80,000 is $24,000, so another $24,000 comes in during January.
Right. And you can already see, even with $100,000 in sales, only $44,000 of that is realized as cash in the same month.
Now for stream 3, this is where past sales fuel the present. We look back to December's credit sales. December sales were $200,000, so $160,000 was on credit.
And our pattern says 50% of December's credit is collected in the following month, which is January. So 50% of that $160,000 is a massive $80,000
That's the single largest piece so far.
by far.
And the final stream must be the stragglers. The money from 2 months ago, from November. November sales were $100,000, so $80,000 was credit.
Correct. And the pattern allocates 18% of that $80,000 from November into January. So that last stream is $14,400.
So let's add them up. $20,000 plus $24,000 plus $80,000 plus $14,400. The total cash collected in January is $138,400. This seems tedious, but why does having this exact forecast matter so much?
It separates the amateur from the professional, the panic company from the proactive one. Just think about the contrast between two businesses when they need money.
Okay, paint the picture. The disorganized business.
The disorganized business knows they have payroll due Friday. They realize their cash account is short on Wednesday. They show up at the bank in a panic, needing money immediately. They're begging. The bank sees desperation, sees high risk, and forces them to accept terrible, high-interest emergency loan terms. Their poor planning literally costs them money and credibility.
And the organized business, using this cash budget.
They walk into the bank on January 1st. They present this detailed budget showing precisely $138,400 in collections for January and then detailed projections for February, March. They show the bank, for instance, hey, collections look great now, but we forecast a liquidity crunch in March when a big order is due.
So they ask for a line of credit in advance.
Based on credible data at a scheduled professional rate. This proactive approach gets them better terms and establishes them as a stable, competent borrower. That calculation is the foundation of their financial reputation.
That's a powerful distinction. So we've traveled from credit policy as a competitive shield through the stunning financial impact of that sales discount, that 37.2% cost of delay, and landed on the essential management tool, the proactive cash budget.
And everything in that forecast, the entire calculated future of the company's cash, it all hinges on the stability of that historical collection pattern, that 30%, 50%, 18%.
Which raises an important final question for you, the learner, to consider. We know that pattern is based on history, but what kind of sudden external shock would instantly break that pattern? If your industry faced a rapid recession, or if a huge competitor relaxed its own credit terms, what would cause your customers to immediately slow their payments? And how quickly would you need to detect that shifting pattern and overhaul that budget before your carefully planned cash ran out?
Relying on the past is crucial, but knowing when the past stops predicting the future, that's the sign of a truly strategic manager.
Food for thought. Thank you for joining us on the deep dive.